Robschild. No investment advice. Welcome to Robschild's Daily Reminders Macro View Update. I'm going to go through my website. You can read through it yourself in the description. Figured I'd do it on a video since not everybody wants to read it. Here's the website. Daily Reminders, Robschild's current macro views. Latest update. June 11th, 2025. I made some minor adjustments, added a small section since the last update in April. Why I believe a major recession or depression has gained significant probability since October 2022. Reasons and explanations below. First point. The 3-month 10-year Treasury yields were inverted for over 2.5 years, now sitting around zero. An inverted yield curve just means that the U.S. Central Bank, the Federal Reserve, has made short-term interest rates higher than the long-term ones. So it's more profitable to park your money in something super safe like a money market account instead of locking it up in a long-term investment like a CD or Treasury bond. When this happens, it gets harder and more expensive for people and businesses to borrow money. Why? Because the guaranteed returns on short investment savings are going up, so lenders demand higher rates to make loans worth it. This is exactly what the Fed wants. They're trying to get people to lend less, borrow less, and save more to cool off inflation, aiming for their target of around 2% per year. Historically, when the 3-month and 10-year Treasury yields stay inverted for over a year, it almost always signals a coming recession. This time they were inverted for over 2.5 years, a very strong signal. That spread is now hovering near zero, which means the economy is close to the tipping point. In other words, the warning light has been flashing for a long time, and now it's starting to go solid red. Look at the link below and see what happens after this goes below zero and comes back above zero. Note the shaded gray areas are recessions. And I have the resource right here. We can click it and we can take a look at the chart. Out to a max view, the dark black line down here in the middle, that's zero. When it goes below zero, it means the Fed is tight. It means it's better to save money and not invest it, not lend it to businesses. And what happens to that right after, right when we're done strangling? Gray bar recession. Again, in 2000, strangling, coming out of it, recession. Great financial crisis, strangling. The economy is just too hot. And then what happens when they're done strangling it? Gray bar recession, the great financial crisis. Even before COVID. Many people are unaware that we did have yield curve inversion right before COVID. We were actually cutting the Fed funds rates. We'll get to that later in the video. It's further in the website. But we had an inverted yield curve and we came out of it. And coincidentally, that's when COVID hit and we had a little mini recession there. Now, since the October of 2022, we have been inverted and then recently uninverted and sort of just sticking around zero. I still count this as being inverted considering that you're not getting hardly any more money for investing your money in a 10-year Treasury security than you are getting from a 3-month one. So is it different this time? Are we not going to see a recession in the near future? Considering how long the inversion has gone for and how deep it's gone, I would not be surprised if it actually ends up being the first depression that we've seen in 100 years. Back to my website, back to the next point. The 10-year break-even inflation rate has been 2.0 to 2.6% for over 2 years. What is the 10-year break-even inflation rate? The 10-year break-even inflation rate is what the bond market expects the average inflation to be over the next decade. It's calculated by taking the difference between regular 10-year Treasury yields and 10-year TIPS. TIPS standing for Treasury Inflation Protected Securities, and the yields of those. If the break-even is 2.5%, investors expect inflation to average 2.5% per year for the next 10 years. Why it matters. Even though there's been a lot of fear and noise around inflation running out of control, the actual pricing in the bond market tells a different story. The 10-year break-even inflation rate has stayed between 2 and 2.6% for over 2 years. That's right in line with the Fed's long-term target of around 2%. The message? The markets are saying inflation might flare up short term, but over the long run, it looks manageable. This range tells us that investors are not pricing in runaway inflation. They expect the Fed to do its job eventually and keep inflation in check. This matters because long-term inflation expectations are a key anchor for everything from interest rates to business investment to stock valuations. If the anchor is holding, the ship isn't drifting. And we're going to go ahead and take a look at the 10-year break-even inflation rate. As you can see from this chart, since 2022, if we highlight just this section, we've been in a range peaking at the beginning of this at 2.6%, not really going that high again ever since. In fact, we briefly had the 10-year break-even inflation rate hit as low as 2.02% in September of 2024. And then very much more recently, we have been trending actually lower with lower highs and lower lows. I want to add to this part of the conversation that, when everyone was saying, hey, hold on, why is the Fed cutting rates in September? When the rates started beginning. When the first 100 basis points of started cutting. Remember, we were hiking when this was going higher and higher. It was like, we better put on the brakes for the economy. And then when we got to this point, when it was down to 2% and looking like it might continue to drop, that's when the Fed stepped in and said, nope, we're not letting disinflation happen. And that's when they eased by 100 basis points. Some people think it has something to do with the election, but it's very clear in this chart what was going on. This is one of the main tools that the Federal Reserve uses to determine whether or not it needs to raise rates, hold rates steady, or cut rates. We probably honestly won't start seeing more Fed cuts until this continues to the downside, and it looks like we are indeed still headed there. With current talks about tariffs making inflation maybe go higher, maybe get sticky, the 10-year break-even inflation rate is not reacting in a way that suggests that inflation is going to stick around. In fact, it is showing a little bit of the opposite. Point number 3, the Somme rule was triggered in July of 2024. The Somme rule is a recession indicator developed by economist Claudia Somme. It's based on the U.S. unemployment rate. Here's how it works. If the 3-month average unemployment rate raises by 0.5 percentage points or more from its low over the last 12 months, the Somme rule signals that a recession has likely already begun. In July, this rule was officially triggered. What that means? The job market has weakened significantly and quickly. Historically, this rule is nearly perfect. It doesn't give early warnings, it gives confirmation of a recession. It doesn't predict a recession, it says it's already here. Why it matters. While the Fed, media, or Wall Street might debate the timing, the Somme rule cuts through the noise. If it triggers, the economy is already contracting or very close to it. Historically, recessions follow within months, if not already underway. This supports what other indicators like the inverted yield curve and tightening credit have been saying for a while. So what does that look like on a chart? From Fred, you can take a look at the unemployment rate. All it really means is once the unemployment percentage rate starts curling up fast enough and steep enough, it means recession time. Curl up, recession time. Curl up in the end of 1979, recession. Into 81, going down unemployment just fine into 1990, curling up, recession. The dot-com bust, going up, recession, curling up into the great financial crisis and spiking. We didn't have a curl up in the COVID collapse because it was just an sort of an instantaneous spike. But As you can see from this chart, ever since 2022, we have been rising pretty significantly. And, we've been planning out really since July of 2024. If once we start ticking higher, I suspect very strongly that it will run away to the upside and get out of control before the Fed decides to start cutting rates and other measures are taken to try to slow down unemployment from getting out of control even further. Moving on to point number 5, the S&P 500 is extremely expensive with a PE ratio of 27, a CAPE ratio of 33, and a dividend yield of 1.4% with no major earnings contraction. The S&P 500 is extremely expensive. Right now, the S&P 500 is priced for perfection with those numbers that I just listed above. The dividend yield as of today is actually 1.3%. Sorry for the discrepancy. These are historically elevated levels, especially the CAPE ratio, which smooths out earnings over 10 years. The market hasn't been this expensive outside of bubbles like 2000 or the late 2021 tech melt-up. Why it matters? High valuations mean the market is priced for strong growth and low risk, but here's the issue. There's no major earnings contraction yet, despite tight credit, slowing growth, and a triggered SOM rule. If earnings start to fall while valuations remain high, the market could reprice very fast and very hard, upwards of potentially even 85% to the downside. I'm predicting myself at least a 50% decline from the 6100 level in the S&P 500 myself. This setup is a classic late cycle danger zone when everything looks good on the surface but cracks are forming underneath. And you can see these three references here. First, the Cape-Shiller ratio at 37. This chart is 150 years old. You can see one notable time was in 1929 when we got to an all-time high of 31.5 on the Cape-Shiller PE ratio. That means over the past 10 years, you take the current price of stocks and you have to pay basically $31 for a company making only $1 in return. And so stocks were very, very expensive at that point. And then since then, we have not seen that high of a valuation for a very long time, all the way from 1929 all the way until about the 1990s, before the great the dot-com bubble and subsequent collapse. And right now at 37 in the Cape-Shiller ratio, you have to pay $37 for $1 of return. There is an enormous amount of money that is packed into stocks, and if this drops by half, it gets down to what's considered to be a normalish range over the past 150 years. That implies a 50% decline in stock prices, and that's not even accounting for if stock earnings contract and bring the average earnings down. If you got earnings compression along with price earnings contraction, the stock market could go down way more than anybody thinks. Just for reference, in 1982, we had a Cape-Shiller ratio of only 6. It costed $6 for $1 of return. Or, for example, in 1920, $5 briefly for an average of $1 of return over the past 10 years of earnings. The overvaluation in stocks is one of the reasons Warren Buffett, for example, has about a third of his famous investing company, Berkshire Hathaway, about in cash, owning an enormous amount of the money market T-bill market. He's no idiot when it comes to the idea that stocks seem a bit expensive right now. Now, when you take the smoothing out of it and you just take a look at the current PE ratio, you get some spikes here that have somewhat to do with earnings contraction, because when earnings go down, then the price seems even higher. We are still abnormally high, around 29 in the regular PE ratio, a level rarely seen in the past 150 years. Sometimes it costs $6 or $5 to buy $1 of return in stocks. And right now it's $29. That $1 of return for the companies in the S&P 500 is extremely expensive. And if that $1 were to go down to 75 cents, 50 cents, and the price stayed the same, that would mean that this would double. In order for this to stay the same, the stock price would also have to go down by 25 or 50%. The third chart that I reference in the S&P 500 being very overvalued is the dividend yield itself. How much money is owning the S&P 500 paying out? When you own SPY or VU, one of these ETFs that owns the S&P 500, how much cash is it sending your way? Well, in 1877, it was sending you 9% dividend. Let's see here. In 1918, it got up to almost 9.5%, and we've never seen it really below 3% over the past 150 years until the 1990s, when people decided, hey, these big companies, they're smart. They can invest a lot of money in research and development and just keep making more money. And that has worked out pretty okay. The music keeps playing until, we get to the point, if we ever get to the point where investors say, hey, you know what, 1.3% dividend yield on owning stocks is not actually enough. Again, it's lower than half of what was expected as the lowest possible dividend yield for almost all of American stock market history. And even just looking at more recent times, we've never seen it this low since the dot-com bubble, when it got down to a low of 1.1%. Since then, we've been above 1.5% most of the time, and currently at 1.3% dividend yield. This isn't because companies are refusing to pay out more dividends. It's because the price of the stocks is so high that those dividends that they're paying out as a percentage of the value of the stock is just really tiny. That's how expensive stocks are right now. They're not expensive. They are extremely expensive. I just can't emphasize that enough. Moving on to the next point. Very tight junk bond spread bottomed at 2.59% in January of 2025, now widening. In January 2025, the spread between junk bonds, those rated below investment grade, and treasuries reached a bottom of 2.59%, signaling a period of extremely low risk perception in the market. This tight spread indicated that investors were willing to take on more risk, assuming that the economy would continue to perform well and credit conditions would remain favorable. This was a sign of euphoria and overly optimistic outlook for the economy. What's happening now? Recently, the spread has begun widening, signaling that the market is starting to price in more risk. A widening junk bond spread means investors are demanding higher returns to compensate for rising credit risk. This shift may signal increased market uncertainty, possibly due to concerns about the economy or tighter financial conditions. Why it matters? The widening junk bond spread could be an early warning sign of economic stress ahead. When investors start to require higher yields to take on risk, it typically signals that they expect lower corporate earnings or increased defaults in the near future. This could point to a potential economic slowdown, especially with other indicators like the inverted yield curve and rising unemployment. Now we're going to take a look at what that looks like on a chart from the reference here from the Fed again. High yield index option adjusted spread. This is junk bond credit spreads. How much more do lower credit companies have to pay for their debt? When they borrow money, what's the interest payments? What are their mortgage payments, in other words? So these things can go up and down. They can get as high as 20%, like in the worst part of the great financial crisis, or, coming out of the dot-com bubble, 11%. And those are periods when junk bonds are very cheap and the markets are not being very complacent. They're very scared. Those are great times to be buying stocks, to be buying higher risk things because they're really, really, really cheap. But what about right now? Well, right now, the credit spreads, like I said in that title, it was January of 2025, where we briefly got down to 2.59%, suggesting insane complacency before we had that major April spike of credit spreads, and then since then cooling off, but notably still finding a higher low. We had a low, a higher high, and now a higher low. If this continues to widen, it is very, very obvious at that point that risk is being taken off the table, that the value of stocks is having its legs sort of taken away from it. Now, just to put this into perspective, the same thing, I like to point this out, was going on right before the great financial crisis. People were only requiring as low as 2.5, 2.4% higher than the Treasury bond rate. In May of 2007, everyone was like, hey, yeah, I'll lend you my money because, hey, there's no chance that you'll default on me. There's no chance that I could lose money. And plus, you're going to pay me a little bit extra yield, 2.4%. Why not? I'll take the risk. And what happened soon after? Well, credit spreads widened in the great financial crisis to a peak, looks like here, of almost 22% higher than Treasury bond rates. The most important takeaway here is that when credit spreads get unusually tight, as they have been very recently, it's not a sign that everything is probably going to be honky-dory perfect and it's worth taking only a little bit more yield for a lot more risk. In fact, it just screams complacency. It says that everybody is saying the wrong thing exactly at the wrong time, as they typically do. Since that bottom, we had a major spike, and I think that there's only a matter of time before we start seeing another major spike and rise to credit spreads. Next point, rate cutting cycle began in 2024, September, November, and December of 100 basis points. In the latter part of 2024, they started their rate cut cycle with 100 basis points total cut, starting with a strong 50 basis point cut and then 2 more 25 cuts. This aggressive move signals a shift in monetary policy, often driven by concerns over slowing growth or inflation control, like I showed earlier in the video, with the break-even inflation rate getting down all the way to their actual target of 2%. This was being priced into the break-even inflation rate market. Further cuts are highly expected well, this isn't true anymore. Pretend that's not there. I'm going to have to do another update of the website. Sorry, guys. The first cut, it looks like, is going to be, I think, in September now of 2025. So, yeah, it's being pushed out a little bit. But anyway, why it matters. A rate cutting cycle typically signals that the central bank is responding to economic weakness or financial stress. Lower rates make borrowing cheaper, stimulating spending and investment, but they also reflect an underlying concern that the economy isn't operating at full capacity. In this case, the Fed's action could indicate a desire to boost the economy amidst rising recession risks. And we're going to take a look now at the Fed funds rate. This is the overnight rate that banks can lend to the Fed directly when they push them up to the sky like they did from, the end of 2021 all the way through 2024. That's like slow down economy. Now, what happens when the Fed does that? It says slow down economy, and then we get a gray bar where we have a recession every single time. Slow down economy, recession. Slow down, recession. And then what happens during a recession? Cut, 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 cut. We have to cut aggressively to get ourselves out of the recession. When we are cutting aggressively, it's not suggesting that things are good. It's suggesting quite the opposite. It's saying that the Fed is really worried about the economy slowing down, and that's what happens when we have recessions. So we rise before the recession and we cut in the recession. We rise before the recession, we cut in the recession. Believe it or not, before COVID, we were rising, and we were actually cutting before anyone had even heard of COVID, before we got that COVID collapse. And then since then, we had inflation get a little hot, so they finally said, okay, it's hot enough. We're going to slam the brakes on the economy. That's what they did. They rose it, and now we're cutting. And what do you think happens next? I am supposing that the rates will continue to the downside soon as there is even a small inkling of the jobs market cracking. And one more piece to this that a lot of people don't talk about is that when the rates are high, it means that people are making a lot of money off of their savings. And when we cut rates, not only does it try to encourage lending into, the economy, it also takes the candy bowl away. This 5.3 overnight percent rate, it was like a free candy bowl for the banks, all this money being created, essentially. When we get cuts, it takes that guaranteed income away. And with the enormous fiscal deficit situation that we are now in, I'm curious if that's going to have much more detrimental effects than anybody else realizes. Next point, record high home price to income ratio and all-time high gold prices relative to home prices. The home price to income ratio is currently at record highs. Do you remember the housing bubble of 2007? Guess what? Homes are more expensive right now than they were then. We'll take a look at that chart in a moment, signaling that homes are becoming increasingly unaffordable relative to income. Meanwhile, the price of gold has reached an all-time high compared to home prices, which suggests that gold may be overpriced in the current environment. Why this matters? Gold price overvaluation. With gold trading at elevated levels, especially compared to home prices, it's a sign that gold could be in a bubble. Historically, when gold becomes overpriced relative to other assets like real estate, it often signals a potential correction, as investors may be overestimating its value as a safe haven. Break-even data, the 10-year break-even inflation rate, currently between 2 and 2.6%, means inflation expectations are moderate. Given this, the high price of gold might not be fully justified, as gold tends to perform well only when inflation fears are significantly higher than those break-even levels. Implications. The overpricing of gold could be a sign that the market is in a speculative phase. If inflation expectations remain anchored, as reflected in the moderate break-even inflation rates, gold may experience a correction. The high home to price to income ratio combined with inflated gold prices suggests that there's significant mispricing in both housing and commodities, another signal of economic correction ahead. References: median to income to home price ratio. Before we get there, also, crude oil has never been cheaper compared to gold, ever. Also, when you compare it to copper, these are two very economic things compared to financial assets. Financial assets being in a bubble, when things go the other way, watch out. But anyway, so taking a look at this chart, this is home price to income ratio. How many years does it take for a median household income to earn the amount of money that it costs to buy a regular house? You can see this chart goes back, it's hard to see here, but this chart goes back to 1947, where we were at an elevated rate of 6.5 years to earn a house. In the 70s, it cost only 3.6 years of labor to buy a house. And yeah, we were around there, between there and 4.6% up until about the year 2000. And then when we got into the housing bubble, like everybody called it, in 2006, you had to work a whole 6.8 years. Houses had never been more expensive before the housing bubble collapsed, and we went straight into the great financial crisis. And what has happened since then? Holy moly. Unbelievable nosebleed level of how much work it takes to earn a home at 7.36 years to now purchase a home from median income. So are home prices too expensive, and are they going to collapse, or is everybody's income going to double next year? Well, if you know anything about how the world works, income tends to trail behind everything else, and so I believe the more likely outcome is going to be an absolute catastrophic collapse in the housing market. Next up, CPI, Consumer Price Index, turns negative in March of 2025, first time since May of 2020. As a part of the evidence supporting the growing probability of a major recession or depression since October 2022, the Consumer Price Index, CPI, showed a negative reading in March 2025, the first time this has occurred since May of 2020. A negative CPI signals that the prices for goods and services have fallen, marking a potential deflationary shift in the economy. Why it matters in the context of a recession risk. A negative CPI suggests that inflationary pressures are easing significantly, which may indicate weakening of consumer demand or slowdown of economic activity. This could be part of a broader economic slowdown that points toward recession risks. Decreased consumer spending. A negative CPI may reflect a contraction in consumer spending, which often occurs during economic downturns. Falling commodity prices, declining prices in key areas like energy or raw materials could also be a sign that global economic growth is slowing. As you probably well know, crude oil is at 4-year lows as I speak, further supporting the case for recession. Implications for economic outlook. Deflationary pressures. A negative CPI could signal deflation, which poses additional risks to economic stability, making it harder for businesses to grow and increasing the real burden of debt. Monetary policy shift. If deflation trend persists, the Federal Reserve may shift its stance to easier monetary policy, possibly driving further rate cuts to combat the economic slowdown. This shift in the CPI aligns with other indicators towards increasing likelihood of a major recession or depression, adding further weight to the case that economic conditions are deteriorating. Looking at the CPI month over month from Trading Economics right here, we can see March was negative for the first time in a long time. For people worried about inflation, well, that was literally a month where things actually got cheaper overall. Next point, April Consumer Sentiment Index, 52.2. This was revised up from 50.7, which was what I had on my website before the most recent update. It's still, it was the second lowest on record since 1952. Now it's the third lowest on record since 1952, but it still stays the same. I forgot to update this part. Please ignore it. In April of 2025, the consumer sentiment dropped to 50.8 before being revised to 52.2, marking the third lowest reading since 1952. This dramatic decline of consumer sentiment further supports the view of that the probability of a major recession or depression has been steadily increasing since October 2022. Why it matters in context of economic downturn risks. A significantly low consumer sentiment index typically signals that consumers are extremely pessimistic about the future economic outlook, which can have several important implications. Reduced consumer spending. With sentiment at such a low level, consumers are likely to cut back on spending, the key driver of economic growth. This slowdown in demand can drag down overall economic activity. Weak economic growth. Historically, low consumer sentiment has been closely correlated with economic slowdowns and is a precursor to recessionary conditions. Implications for a potential recession. I think that's supposed to be in title format. But anyway, increased savings, reduced investment. A drop in consumer sentiment could lead to higher savings rate and reduced business investment as both consumers and companies become more risk averse. Confidence crisis. The prolonged low sentiment could signal a crisis in confidence over the broader economy, adding to the growing risks of a deep recession or even depression. This sharp decline in consumer sentiment, coupled with other factors like a negative CPI and inverted yield curve, strengthens the case for significant economic challenges ahead. And as we can see from the FRED, the University of Michigan Consumer Sentiment, part of this chart is broken. You can see the dot bouncing around before the 1980s. I really wish someone would fix this. But anyway, 52.2%, only seen two other times in history, July of 2022, and the worst it ever was before then was in 1980 at 51.7. Even during the great financial crisis, consumers were not this pessimistic, if you can believe that. I should repeat that. Even during the great financial crisis, consumers have never been more pessimistic. Or rather, are more pessimistic now than they were during the great financial crisis. This is not a small deal. This is a big deal. Only two more points to go. Next point, coordinated deflation. Trump's fiscal hawks, Powell's fade, and the asset bubble slow bleed. Since October 2022, we've entered a phase where monetary and fiscal policy are aligning intentionally or not to slowly deflate the everything bubble. Despite public sparring, Powell and Trump both want lower interest rates and both know they need to bring asset prices down before the consequences become systematically destructive. With Scott Bessent now serving as Treasury Secretary, that coordination is more deliberate. Bessent is a fiscal hawk, and his nomination was seen by markets as a signal that Trump 2.0 is willing to prioritize budget discipline, even at the expense of growth. His 3-3-3 framework, 3% GDP growth, 3% deficit to GDP, and 3 million additional barrels of daily oil output puts real constraints on future stimulus, and his policies are beginning to complement the Fed's passive tightening posture. Looking ahead, the next Fed chair, whether it's Bessent himself or Kevin Warsh, a former Fed governor with hawkish leanings, is unlikely to be a dove. Both represent a shift away from the ultra-accommodative policy era. This would reinforce the cooling effect, a fiscal monetary regime not looking to reignite the bubble but to contain it slowly and in full view of the markets. Key dynamics at play. The Fed no longer fears deflation. Post-COVID, Powell explicitly stated he wanted to see inflation ticking above 3% before acting. Inflation then overshot massively, proving that it is possible to achieve even sticky inflation with the right combination of fiscal deficits and easy money. Now that we're back near 3% and break-evens are stable between 2 and 2.6%, the Fed is no longer scared of deflation like it was over the last 15 years. That shift in fear removes urgency from the Fed's rate-cutting cycles. It means that they can afford to be lazy and late with easing, deliberately letting the bubble cool. Number 2 of the key dynamics at play, fiscal policy is turning restrictive. Under Bessent's Treasury, fiscal tightening is creeping in through targeted spending cuts, deficit caps, and rising tariffs. While stimulus drove much of the post-COVID inflation, the U.S. is now facing massive deficits that weaken the effectiveness of monetary policy. Fiscal policy is doing more of the work, and it's not growth-friendly right now. The goal is to stabilize debt markets and signal long-term solvency, but the side effect is slower nominal growth. Point number 3, tariffs echo pre-depression era moves. Trump is pushing tariffs again, especially on China, despite some recent moderation. Historically, perfectionist trade policy like the Smoot-Hawley Tariff Act of 1930 deepened the Great Depression. The similarities are unnerving, slowing growth and tightening policy, and now a reemergence of trade barriers. Bessent, despite his Wall Street roots, appears to be working within this framework, possibly to fund the deficit via customs revenue while keeping spending restrained. The big picture: coordinated cooling before the collapse. Powell and Trump don't trust the current asset bubble to keep inflating safely, especially with record high valuations, excessive leverage, and geopolitical instability. Whether it's by intent or necessity, fiscal and monetary forces are now aligned to let the air out slowly. Besant's treasury adds precision and intention to that effort. And with Powell's term ending in 2026, a replacement like Warsh or Besant himself could lock in more hawkish regime, one that's willing to tolerate tight conditions longer than markets are used to. They want to avoid a panic-driven collapse, but the danger is that they've already over-tightened into a fragile system. And the last point: continued jobless claims, elevated on the verge of breakout. Headline unemployment remains at 4.2%, but the labor market's internals are deteriorating. Continued jobless claims have been grinding higher since early 2024 and now sit well above their pre-COVID highs. This isn't about isolated layoffs. It's a sign of growing persistent unemployment, where displaced workers are increasingly unable to re-enter the workforce. Compounding this, the labor force participation rate peaked in August of 2023 and has been slipping steadily ever since. Fewer people are working, and more of those who exit the workforce are staying out. This reflects structural erosion, not just a short-term slack. Why it matters: both continued claims and the participation rate are now sitting at inflection points. A decisive breakout higher in claims or a sharp rollover in participation would mark a transition from benign labor softening to outright breakdown. The market remains focused on headline jobs data, but the deeper internals are flashing early warning signs of systematic labor stress. And we're going to take a look at the references, starting with the continued jobless claims. This is seasonally adjusted, but it's if anything, it's adjusted in a way to make it look more peachy than it actually is if you look deeper into the numbers. But when you take a look at from June of 2022, we have been rising, going flat. Another wave higher, going flat. And very, very recently, we've been making multi-year highs. In April, we found 4-year highs in the seasonally adjusted continued claims, basically matching that the week of May 17th. And then just last week, the report ticking down only a tiny little bit. When you have week after week, these are not like the pattern where we've seen, even with seasonally adjusted data, we still usually see up, down, up, down, up, down. This is staying high. This is getting sticky up here, which tells me we are really on the verge of a breakout, maybe as early as tomorrow, June 12th, but we'll see. And then lastly, taking a look at the labor force participation rate, you can see in this chart, this goes down in recessions. And although not totally cracking apart yet, since August of 2023, we have been clearly getting lower lows and lower highs, a pattern suggesting that this is still continuing to fall to the downside. Now, scrolling out on this chart, labor force participation rate, you can see that overall the participation rate has been higher than in the past, and notably the range here is only between 58% and a max of 67%, but it has to do with the cultural shift of more women participating in the labor markets. And really what I want to note here is that since 1980 we haven't been this low generally, around the 62. Right now it's 62.4. This is, for male and female, more equal labor force participation rate really since the 80s. We're lower than the 80s right now at 62. In the 80s, when it was previously not really lower since then, we were in the we were above that. We were above 63. And we are getting, obviously, you can see right here, we are below most of the period between 2013 and 2019. This is not what a healthy labor force participation rate looks like, especially in today's modern age. So that's it. Those are all the reasons why I believe a major recession or depression has gained significant probability since October 2022. Sorry about some of the errors. I'll try to fix those as soon as possible. You can find this same website in the description of this video. Thank you for watching, and see you next time. Robschild.